Good evening to everyone present here today. We have our product manager Jason D'Souza who will reveal the best strategies to identify GARP stocks. Towards the end, we would also be having a Q&A session. Over to you, Jason.
A very warm welcome to each and every investor gathered here today. Now, the investor world could be classified under two broad segments. On one side, we have value investors, where they hunt for stocks that are attractively valued in the current market or are trading at a discount to its current market price. And apart from value investors, we also have growth investors. Now, you should understand that when there are growth investors, value takes a backseat, and these growth investors hunt for earnings growth, sales growth, so on and so forth. There is also a middle ground, and I don't know if many investors are aware of, which is known as the GARP way or the GARP model of investing. Okay, it's nothing but growth at reasonable valuations or at reasonable prices. Let's start off today's event. A disclaimer: investment in securities is subject to market risk. Past performance should not be construed as a guarantee for future returns. So let's understand the strategy. Okay, before that, let's take a step back and go to our traditional models of growth versus value. Okay, now to distinguish between both of them, when you talk about growth stocks, they are a bit expensive and they trade at a premium. Whereas value stock, as the name suggests, they are attractively valued companies. Okay, the second is that growth stocks have low or no dividend yields, whereas value stocks generally have higher dividends. The third one is that growth stocks are usually more volatile with price movement. Okay, they move up and down really quick, whereas value stocks are relatively less volatile. Now we need to understand that these stocks have a margin of safety because they are attractively valued, okay, and they are less volatile in nature versus the growth model. And lastly, the growth consists of small companies with high growth prospects, and whereas value are usually found among larger, more established, mature companies. Now that you have some idea of growth versus value, let's move forward, and I want to show you all a few points, okay, just 2 points on these two different strategies. Now, when we talk about the growth strategy, if you look at the current atmosphere, okay, there is high interest rates, okay, this often dents earnings and growth takes a sidewalk, okay, growth strategy moves towards the side over here. And the other point is that during a global risk off sentiment, okay, when people are usually not hunting high growth equity stocks, the inflow towards growth strategies and stocks also reduces. Now, value on the other hand works very good during the current economic or some liquidity contraction. In the current atmosphere with higher interest rate regimes, value stocks work better than growth. But there's one point in value which I wanted to actually explain to you all today, is the value trap. Okay, now we often see cheap stocks in the market or attractive stocks in the market, if I may say. And we think that since their price is low, they're trading at a discount, this is a value stock. But you have to understand, it cannot be a value stock if the quality is not good. Just because the price of a stock is low, just because the price of a stock is extremely low compared to its other peers, that doesn't mean it's a value stock. You need to understand its earnings as well and what's the quality of the stock in the market. Okay, that's known as a value trap. So if you're ever going to hunt a value stock, understand that price is not the only factor, they have to be fundamentally strong as well. But keeping this aside, can we actually get the best of both worlds? Okay, what I mean by this is that, can we take the positives of the growth strategy, the positives of the value strategy, and form a model which comes somewhere in between? Here is what I would like to reveal as the GARP model of investing. And this was propagated by Peter Lynch, okay, former manager of the Magellan Fund. And he's credited with popularizing the strategy of mixing stocks with reasonable valuation and strong earnings growth. Okay, so here you can see the mixture happening and the GARP model was discovered. But Peter Lynch has made this one very important statement in one of his famous books, One Up on Wall Street. Now, I would suggest investors to read that book. Okay, it's an evergreen book and a lot of people in the market have actually read it. He has focused on this one important tool called the PEG ratio. Okay, now what exactly is the ratio? I'll be taking on the next slide. But before that, when he practiced GARP investing, he searched for businesses where the PEG ratio is less than 1. Now, if you know, in my webinar events, I don't actually dive deep into ratios. I don't go into technicals because I understand there might be some investors who are not that well versed with finance. But today's event, I actually want to take the liberty and break down what is this PEG ratio and why are we putting so much importance on this. Moving to the next slide, let's understand the role of PEG in GARP stock picking. Now, PEG is derived from this very basic ratio, which is known as the PE ratio. All of us actually talk about it. Okay, it's nothing but the market price divided by the earnings per share, or the price of that market cap divided by earnings. Now, let's not get too confused. We also have something known as the growth. So when I say PE and the G comes from the growth, this is nothing but growth in earnings. At Marcus Mojo, we look at the growth in the EPS trailing 12 months. Now look at these two ratios. We have PE and growth below it. Now if I take an example of a stock, I think you'll get some clarity. Let's look at Godfrey Phillips, for example. Okay, just before the event, I don't know if it's the closing market price, but it was trading somewhere around 1845.60. This MPS, this price is nothing but the 1845.60. And then we divided by the EPS, which is 124.44, to get the PE ratio of the stock, which comes to 14.83. Now, the growth when I speak about is nothing but the growth in earnings. So Godfrey Phillips has seen some 50% growth in its trailing 12-month earnings. Okay. What is this 14.83? It's nothing but investors pay 14.8 rupees for each rupee Godfrey earns. Okay, this is the market price. So investors pay 14.83 for each of its earnings, where Godfrey rupees earns 1 rupee. Okay, so now you might understand the essence of the PE ratio. Okay, when we say a stock is trading at an 80 PE, that point of time you should understand, okay, I'm paying 80 rupees for every 1 rupee the company earns. Okay, 14.83 for Godfrey Phillips divided by its trailing 12 months growth. Okay, we get the PEG ratio, which is 0.29 for this company. Nothing but we are dividing these two things over here. Okay, we're just dividing these two components over here and we're getting the PEG ratio, which is at 0.29. Now, what does Peter Lynch say? That as long as this PEG ratio is below 1, the company's growth is not fully reflected in its present price. Let me repeat it. As long as this ratio over here, the 0.29 is below 1, okay, the company's growth is not reflected in its prices. As long as this ratio goes, let's say it goes over 1, and we look at cases at that time as well, then you're actually, paying higher for a company and the growth is lower. But as long as this growth is high and this value comes up to below 1, that's when is the first point and when we can identify a GARP stock. Okay, this is a very important part. Below 1, then we can say that, okay, now this stock might be a GARP stock. But when it's above 1, then we say that, you know what? The earnings is not that great. The growth in earnings is not that great. And it's trading at a very high price multiple. Now, I think this is just one example. Let me give you a few cases so that you get more clarity. Now, when can this number go above 1? Now, we are searching for stocks where the PEG ratio is below 1. When can this number actually go above 1? Let's look at two different cases. Again, I'm plotting the PEG ratio, which we got the answer as 0.29. But let's look at this case. Let's say the stock becomes expensive. From the 1,500 range, it becomes 7,500. Now the PE ratio becomes 60 and the GARP ratio goes above, the PEG ratio goes above 1.20. Okay, when the stock becomes expensive, the price increases, the PEG goes up, and now it's not a stock which qualifies in the GARP model. There's another case. Let's say the growth slows down. Okay, let's say that this particular 14.83 is the same, but the growth from 50% becomes 10%. Now in this case as well, the PEG ratio moves up. So you're getting my point over here. As long as the PEG is less than 1, that's when you can identify the stock, whether it belongs to the GARP model or not. Okay, now going forward, we'll now slowly look into the screeners so that we get some idea. Before that, I have done this in my previous events as well when I did value versus growth. It's important for you all to understand the style matrix. Now, apart from understanding the GARP model, we already have our money invested in the equity market. We're already investing in different stocks. We're already investing in different mutual funds, or let's say a PMS house. It's important for you to understand what's the style matrix of that fund. The reason I'm saying is you would actually know then how your portfolio is performing and what's the reason for it. How can you actually attribute that return? The return you're making, which style are you actually following? Many investors don't know about this. Let me place this simple matrix for you. We have large, mid and small caps, and we have value, growth, and in the between is the blend. It's the GARP strategy, what we are going to focus on today. Okay, this is where we are trying to pick stocks today. Okay, we are trying to avoid these ones with only growth potential. We are trying to avoid these ones with only value potential. We are looking at value stocks with also some growth potential. So this is our focus for today. Now, what's the style matrix? I had also gone to value research. You get the style matrix for different mutual funds as well. For example, if you look at ICICI Prudential India Opportunities Fund, it's tilted towards a large cap approach, okay, towards the GARP blended model. Similarly, you can see Parag Parikh Flexi Cap Fund, which is more of large cap but growth oriented stocks. So if you're investing in a mutual fund, this style box is available on many websites. You can actually understand where is the fund actually allocating itself to. Okay, now that you got some idea what is this PEG ratio Peter Lynch was talking about, what exactly is the style and what exactly is value versus growth, let's create a very basic screener. Let's create a very basic screener to see which stocks are actually qualifying in this GARP model. Okay, I'm going to show some few ratios. Let's go step by step. We're going to look at growth and we're going to look at valuation. We're going to look at growth in top line and bottom line, and we are going to look at the PEG below 1, which is basically a cheaper valuation. PEG less than 1, we have this filter on the Marcus Mojo website. I'll take you to it. Sales growth 1 and 5 year is greater than 15. Profit growth 1 and 5 year is greater than 20. Now this 15 and 20 is what I've put on my slide. Okay, there's a school of thought where they only look at 20% growth and above. There's a conservative approach where you look at only 10% or 15% and above. These are my values I've added. They are not the thumb rules, okay? And lastly, we look at companies where they are trailing 12 months. So the last 12 months sale is greater than 1,000 crores. Now the reason I'm doing is that I don't want to pick up a very small company, let's say who's making some 10 or 15 crores in the market, and then we are investing in them. Only for this screener, I'll be putting another check that the sales is greater than 1,000 crores in the last 12 months. Let's move to the side now. Okay, let's quickly go to the screener section. Now I've already pre-saved the screener over here. Okay, so I don't have to make it again. So let me just show it to you. Okay, I'll edit the filters again. We said PEG ratio less than 1. Okay, 1 or less than 1. Now the growth 1 year and 5 year. Okay, for the sales and profit. Okay, I'm looking at 1 year for the short term and 5 year for the long term trend. So I get some idea whether the company has performed in the short period 1 year or the 5 year average. Okay, profit growth, sales growth. Then we took the size where the net sales is greater than 1,000 crores. Now here we can see some 78 stocks out of 4,000 stocks qualifying under the pure GARP approach. Now let me run the analysis. These are the list of stocks we can see. Okay, these stocks are attractively valued and also have a high growth potential. Okay, we can see Apar Industries, JK Paper, Bajaj Finance, okay, AU Small Finance, so on and so forth. The PEG ratio is less than 1 and there is growth potential. Now that we made a basic screener, let's figure out one important question in this particular screen. We looked at the PEG ratio, that's great. We looked at the sales growth, the profit growth, okay. But my problem here, one important question is the growth we've selected is based on past performance. This sales growth we're looking at, let's say the PEG ratio, the growth we're looking in the PEG ratio is based on past performance. You should actually spend some time in identifying whether this growth is sustainable and will the company provide similar or better growth in the years to come. What happens is that we are always clouded with recency bias. अगर एक कंपनी ने 20% growth किया है sales में, if that company has grown by 20%, that does not mean it will continue to grow at 20% year on year. You have to actually understand whether that business model is sustainable. The products they are using in the market, do they actually have a shelf life? Can that company continue its growth for the years to come is an important question. So when you look at this GARP model, you should pick stocks less than PEG, less than 1, all that is great. But you should also pick those stocks that have the potential to grow at the same pace. Otherwise, you're identifying a stock based on past performance, it does not make sense. What do I mean by this is now, growth should be sustainable and not one time. Okay, merely focusing on past growth rates would result in recency bias. Okay, let's examine now one or two sectors. I'm selecting one or two sectors where the companies have potential to generate the same growth going forward. So I'll replicate the entire GARP strategy again, but in favorable industries. The reason I've selected some favorable industries because we believe that these particular industries can enjoy the same growth which they've enjoyed in the past. The same screen again. Okay, there's nothing new. There's a PEG ratio, sales growth, profit growth. Okay. Here I'm looking at two industries to be specific, two themes. One is capital goods and one is pharma. Okay, capital goods, nothing because the recent budget, higher allocation of capex this time. Okay, so capital goods sector or these stocks have some higher potential going forward. Okay, pharma also recently there was a particular notice that the scheduled drugs would be, the companies could actually charge higher on that. Okay, so it does affect their revenue, it does increase their revenue. For this particular screen itself, I'm actually looking at these two industries, okay? Now dynamics change. Today I'm talking about capital goods and pharma. Possibly 1 year or 2 years down the line, there might be other sectors which look bullish. Let's say 3 or 4 years down the line, there might be other sectors. So you have to look at themes that are favorable at that point of time. Let me go back to the screen now. We've identified these stocks. I can go to industry. Okay, let me just add, I'll just remove the sales filter over here. Okay, because there might be some very small companies. Okay, then we look at the capital goods sector. Okay, and then we can also look at the pharma sector. Yeah. Okay, so you can see many companies over here. I think there are, yeah. Okay, so within these sectors, the one thing over here which is problematic, there are small and micro cap companies. Okay, they might go bust or they might not actually perform well. They're very small, very risky. But let's see, for example, Samrat Pharma over here. Okay, it's in the pharma industry. It's up by 4% today. But see, one very important thing is it's fallen by 72%. I mean, that's a very big fall in the market. Okay, so this is a clear no-no. But you can look at other stocks as well. Okay, I'm looking at TD Power Systems, for example. Okay, it has a consistent financial trend, and yes, it's also a Mojo stock, and it's also in the capital goods sector. So that's a double benefit over here. Okay, it says consistent financial trend. So let me just look at the financial trend. Yes, the financial trend has also been consistent. Okay, now suddenly if the company declares 2-3 negative quarters, it won't be a GARP stock anymore. The earnings potential reduces. So you have to look at companies where these green sticks come back to back. Okay, they continue to show that growth potential going forward. It's a Mojo stock since 1 month, 2 days. Okay, so the reason I've selected these favorable industries is because when you look at growth, don't simply look at past growth. That growth should continue. This was the first screen. Now let's look at the second one. I've just taken the GARP model and I've added the technical indicators. The reason for that, I'm looking at GARP stocks where the technical is in the bullish range. And when the technicals are in the bullish range, we get some idea that the market is now wanting these stocks. What happens is that sometimes we make very good screeners. We identify very good stocks, but the market actually does not reward them. So here I'm adding one simple filter, which is technicals. It's nothing much. Here you can see I've added a technical filter of mildly bullish and the bullish trend. So let me go back to my screen. I'll just make one quick edit to show you the stocks. So I'll remove the industry and I'll go to technical. Here I'll select bullish and mildly bullish. Now some 98 stocks over here. I'll just run the analysis. Okay, let's see National Fertilizers, small cap fertilizer company. It's up by 6.5% today. Now, okay, now the many small caps you'll see are actually up today. I'll just go off topic. If you want to understand why these small caps are up today, if you look at the Sensex movement, it's up by 0.60. But the mid and small cap index is actually up by 1.6%. Okay, so that's why when most of you might be looking at the website today or looking at stocks, you will see many small caps running by 4 and 5%. Okay, that's nothing but a very good market movement which has come for small and mid caps today. But going back, now we're looking at National Fertilizer again over here. Okay, now this company has changed from buy to strong buy 2 days ago. Okay, it was in the buy range, it's now come to strong buy. And when we look at the technical trend, we'll get some idea over here. Great, the company has turned bullish from mildly bullish. Okay, you can see it was into mildly bullish range, but now it's moved straight towards the bullish range. Adding this filter helps you catch stocks which are currently being rewarded by the market. We often ignore technicals, but understand even if you're a pure fundamental trader, your textbook equation might go right. If that particular stock is not moving up in the technical range, it does not make much sense. So this screener has some 98 stocks. Okay, and here we're looking at GARP stocks which are bullish on the move. So out of 4,000 stocks, we only have 98 stocks over here. Now the idea to select these stocks is that please look at your current portfolio as well before adding all of them. Okay, they are micro cap and very small cap stocks. So it can be really risky in nature. But moving through the third one, which is GARP stocks during a high interest rate regime. Okay, now debt-free companies during high interest rate could provide a margin of safety. Now understand, when the interest rates are really high, if you have a very high debt component in your balance sheet, you're paying higher interests and that's denting your profit. That's denting your profit margin. One safe approach during this current scenario, the reason I've put this screener is because we are facing this scenario today, is to select companies that are debt free. They don't have debt, so they are not that much affected in their balance sheet when it's a high interest rate regime. PEG ratio less than 1, sales and growth, profit growth. I think you all must have highlighted these 4 filters by now. But again, net debt to equity less than 0. We're looking at debt free companies. This gives us some margin of safety during high interest rate regimes. Going back to the same screener, I'll just edit it, and here I will remove the technical grades. Now, where do we get net debt to equity? You can go to capital structure factors, net debt to equity, latest. Okay, here we'll select less than 0, and I'll run the analysis. Now we have 74 stocks that are debt free, have high sales growth, have high profit growth, and a low PEG. Okay, we have West Coast Paper, Lakshmi Machinery Works. Okay, we have many stocks over here which are fulfilling the criteria. Okay, now West Coast Paper again is up by 4% today, a strong buy. Okay, Lakshmi Machinery Works is currently at the whole trend. It was a Mojo stock once upon a time, but you can see the technical trend is not that great. Okay, we also have this one particular small micro cap company which is at 77 and buy, but it has changed from hold to the buy range. Again, debt free in nature. So during this high interest rate regime, adding this particular filter in any of your strategies could be quite useful. Okay. The fourth strategy which I've made is the ultimate GARP screener, and the reason I'm calling it ultimate, I'll just explain to you. We again look at the same ratios. Okay, these 4 same ratios. But why don't we also look at the Mojo dots? I'm adding quality, which is excellent and good, valuation, attractive, technical, bullish, financial trend, outstanding, very positive. So here we're looking at the GARP potential, and we're also looking at the Mojo strength of that company. We are combining the markets Mojo analysis with the GARP model. Okay. Now I'll not make the screener from start. I've already saved it for you, so I don't have to select so many filters. But I call it the ultimate GARP screener. We have 6 stocks over here. Okay, all 6 stocks are doing blazingly well today. You can see RCF is also up by 5.4%. Okay, these stocks, I think there is one small edit over here. I think when it comes to quality, okay, I've not added the quality filter. So I'll just go to quality grades, and I'll add the green dots. Okay, now we have 4 stocks. 4 of these stocks are strongly rated on the markets Mojo parameters and also have GARP potential. Okay, we can look at, let's say, RCF, for example, mid cap fertilizer stock. Okay, now see, it's fallen 34% from its high. So obviously the price falls, it's falling to a very attractive range. Okay, it's at the corner of strong buy and buy. I mean, so at the corner of buy and hold. And the stock has gained after 4 days of consecutive fall. Now, before running and rushing and buying these stocks, understand the stock has corrected from the high. There is something in the market which has been discounted. We can also look at Torrent Power. Now, this is a large cap blended stock. Okay, so it's large cap. Now, if you see the technical indicator is sideways. If it turns mildly bullish and bullish, you're getting some returns there itself. What I mean by that, the company turned sideways. It was mildly bearish. Here it turned, I think, sideways. Okay, and if all this becomes green and you buy this particular stock, you're capturing a higher potential than waiting for it to become a buy rated or a bullish stock. But understand it's currently still at hold at the corner. I'd be more comfortable when it comes to the buy range. But once again, when we combine these, the markets mojo ideology along with the GARP potentials, we have 4 stocks which fall in the list today. Now that we've spoken about these 4 different screeners, let me take you to one Mojo stock with a GARP potential. Okay, I went to the investment company, I also showed them this stock. We have Saxoft, which is a Mojo stock and has a pure GARP potential. If you see, it's added 3 months and 26 days ago. The small cap index is down. The sector itself is down, the IT sector, but this company is up by 20%. So it's showing some strong resistance. Okay, it's actually moving upwards, it's not falling that much. The PEG, as I said, very important, should be less than 1. This company is 0.73, so there is some margin of safety here. Good quality, fair valuation, very positive financial trend, mildly bullish technicals. Okay, once the technicals become purely bullish, the score will also increase. In that style matrix, here is where Saxoft falls. Okay, we are looking at a small cap stock with a blended approach. So here is where that particular company is falling. Great, so this is one Mojo stock approved by the investment committee, has pure GARP potential. Okay, and it's in the small blended segment. And one thing I like about this stock is that it's fought against the market. We all talk about the small cap having some resistance in the current market, but this company has actually fought against it and the sector. Okay, so there is some resistance. Let's look at Saxoft today as well. So it's marginally up by 0.28%, and this company has also been moving up all this day. So just because small cap went up today, this company might not go. You have to understand that it cannot be the day of the stock every day in the market. Okay, there are times when the stock won't perform. Okay, but 1 month it has shown some quite good resistance. 1 week it's down. Okay, but it's moved up today. And if you look at the 1 year growth, it's done excellent at 57%. Where the market has moved nowhere, this stock has moved by 57%. I was talking about the valuation. Okay, it's at a fair range. So it's not expensive. If it was expensive, then it would not be a GARP potential. It's currently at a fair range. And the PEG is 0.72. So it's less than 1. Okay, it's another 20 PE ratio. So you're paying 20 rupees for every 1 rupee the company is earning. Okay, look at I actually do an event where I'm actually breaking down these ratios in a simple way. I think, looking at these ratios, a lot of y'all get confused. So I'll actually help you, in getting each line out. So this is how much you pay for every rupee the company earns, what's price to book value, so on and so forth. I'll try to do an event on that as well. But now when you look at P ratio, I think this is what should hit your head. I'm paying 20 rupees for every 1 rupee the company earns. Okay, for e-mudra, you'll have to pay 56 rupees for every 1 rupee the company earns. Now you know why it's very expensive. Okay, it's highlighted here, very expensive. Okay, so that's how we use the PE ratio, and we divide it by growth where it's 0.72. So it's a go ahead. If you go to quality, you can look at the sales growth as well. Here you can see it's above 15%. It's at 17.5. Okay, we don't have profit growth here, but you can see the operating profit growth is also up by 20%. The 5-year growth is at 21%. So it's a stock with a fair valuation and good growth prospects, which comes in the between of a blended approach of the GARP strategy. Now, apart from Mojo stocks, I also reviewed some of the mutual funds using the GARP strategy. And what I found out, now here's the harsh reality, okay? We've been talking about the best GARP stocks, how attractive these GARP stocks are, how we're using the best of the both worlds. This was a bit shocking. I went across some of the mutual funds. Okay, so now I've only selected 4 over here. I was doing a Google search, so this might be some selective bias over here. But still, out of these 4 funds which have mentioned that they follow the GARP approach when they select stocks, 3 of them were sell, only 1 of it was hold. Now they have outperformed the 5-year category average, but since the going forward doesn't look that great, that's why these are sell, hold rated. Okay, here you can see this particular fund has done extremely poor. 3.775 year CAGR, whereas here you're getting a 9.23 category average. Okay, this is a pure Aditya Birla Sun Life Pure Value fund. They have outperformed the category average, but currently are a sell or hold rated. Okay, this is the harsh reality where some of the fund managers I've seen use this particular GARP approach, but fail in the market. Now that we've looked at the GARP strategy, we've understood this PEG ratio, we've looked at different screeners, we've also identified one Mojo stock. Let me take you all forward and actually explain to you what should be your strategy now. Now that you have some idea of what this GARP strategy is, what should be your strategy when it comes to investing? Now, if you see during bullish trends, growth outperforms value. Okay, in times of this low interest rate and when the entire market is bullish, let's take, for example, COVID, just post-COVID, the entire market was bullish for a year. During this time, growth stocks actually outperform. Now, this is something you'll have to actually learn. But when it comes to the bearish trend, value outperforms growth stocks. Okay, in times of when there's some macro uncertainty, tighter liquidity, that's when you can speak about the current time as well, where value outperforms growth. Now, please understand, which investor can actually predict when it's going to become bullish or bearish? The correct market trend for someone to pick is only understood at hindsight or in a retrospective manner. What I mean by that is, today when you look at the chart of Sensex, okay, let me take you to the site actually, I'll give you a better example. So let me go to markets today. Okay, I'm going to plot the 3-year trend of Sensex. Now here was the COVID low. 3 years back, March 29th, we all know it's the COVID low. So the market is at a low. Okay, now when everyone was over here, no one knew there would be an extended bullish run. Then you were over here, let's say 2021. You didn't know for the next 2 years the market would be trading at the same range. Okay, it's actually below that. I mean, who knew at 2021 we would be at the same place we are today? That's the problem here. The correct market trend is only understood in hindsight. Now that you're sitting here today, you will say, okay, it was bullish here. Oh, okay, it was sideways over here. But in reality, it's very difficult to predict. Okay, that's the reason I don't suggest investors to go with one single strategy. Because you will outperform in one trend, underperform in the other, outperform in one, underperform in the other. If you selected a pure value approach for the last 10 years, okay, it won't actually help you because that strategy will outperform once and have a continuous period of underperformance in the rest of the periods. One strategy only, I actually don't suggest it and I actually don't practice it. If I was a pure growth investor, like purely growth, then I would have told you about it. But I believe on having a mix of both in your portfolio. A combination of the three would be a superior approach. I believe that you should have strong value stocks in your portfolio, which are mature. Okay, they provide you some dividend yield. Okay, and they are strong and they are holding your portfolio. You should have some growth stocks, which can help you run during a bullish run. And GARP falls in the between, also have some GARP oriented stocks. Okay, because you have to understand they are the best of both worlds. A combination would be the best approach. I'm not trying to sell you the GARP approach here. I know I've called you for an event on the GARP strategy, but I'm not trying to sell you something wrong. Please understand a combination of these three approaches would help you perform under every volatile range. One thing I cracked or one thing I could say is that if you're conservative in nature, you should capture this quadrant where you're looking at large cap stocks, undervalue, blend. Okay, you're not capturing much of the small and mid cap range, but you're looking at this particular quadrant. Whereas if you're an aggressive investor, you can look at this particular quadrant. Okay, now you should not only follow this particular thing, but this gives you some idea. When you look at the style box, before you buy any mutual fund, before you buy any particular stock, understand that this is slightly conservative. Okay, you're tilted more towards value and large cap, whereas this would be tilted towards more of growth and small cap. Okay, blend and mid cap and hardly some large cap and value. So this could help you with an aggressive approach. Okay, that's one of the learnings. But still coming to the harsh reality again, I have plotted the S&P 500 GARP Index and the S&P 500 Total Return Index, okay, for both. This is the US market for the last 10 years. Now, one sad thing is that it has not actually provided any meaningful returns. Okay, we all get back to that one particular statement of Warren Buffett that stocks traded at foolish prices. Efficient markets exist in textbook. Even though this strategy looks very exciting, we are picking up growth potential, we are picking up value potential. I mean, I would not say unfortunately, but sadly, the GARP index has not provided any meaningful alpha it's traded in line with the index. If you see here, this black line is the GARP index. If you see, it actually took a big dip over here during March, COVID. It did rise well, but it did not break the S&P 500. That does not mean, it's a bad approach, but it's not a very superior approach. It did not break the S&P 500 index. Okay, when it went down, but here you can see it's trading at a very similar range. So if you had invested in the index, so let's say back here, if you had to select, you had two options back here. One is, I'll buy an ETF, S&P 500. ETFs are cheap, low expense. Okay, it tracks the index. Or I go for a mutual fund manager and pay him a higher expense. What's the use if you're getting the same returns? I could understand GARP took off over here, or let's say the line went somewhere here. Then it makes sense to pay a mutual fund manager to handle your portfolio. And this is quite a long range, okay? It's like a 10-year range. But if you had invested in a simple ETF, you would pay lower expense, less headache, less volatility, and you're still enjoying the same returns. I've not plotted the value and the growth yet, it would get quite confusing. But one thing to understand is this strategy looks extremely good. Very few investors have actually mastered it. Let's look at Peter Lynch. When he used to handle Magellan Fund back in Fidelity Investments, I'm not really sure about the return, but there was some close to 21-22% CAGR for many years. Very few investors can actually master this approach. It's not a very simple approach. When you're picking stocks with the GARP model, understand that even though it looks very good on paper, it has not shown that growth previously. Now going forward, will the same thing continue? Will GARP stocks not do well? That's something even I don't have any idea of. But when you're investing, please understand, past is not that great for the GARP model. Future might be good. Okay, I'm leaving a question mark over there. Before I open the floor for the Q&A session, we do have an offer for all the attendees in the webinar today. We are 26,999 for 2 years, plus you're getting 3 months free. You're getting your fundamentals, you're getting mutual fund transaction as well as advisory, and the trading 80 model. Okay, with that, I would like Mehtab to ask me any questions. And if you have any particular stocks you are confused whether it falls under the GARP approach, please ask them to me.
The first question for today is from Mr. Johnson. Dear Jason, very well covered. How do we assess the intrinsic value of a stock?
Oh, I had recently done this in the last webinar. If you just go to the webinar homepage, okay, go to best of webinars. If you just share my screen, I went to more and I went to best of webinars. Here, this is the one. This is the one which I recently covered. So, over here, I think itself, I have covered about the intrinsic value of a stock. So I would suggest you to go back, go to the webinar highlights page. And here you can actually understand how to find out the intrinsic value of a particular stock. I will not spend a lot of time into actually breaking it down over here, because there I've actually broken down different approaches and given you an idea on how to reach the fair valuation of a stock. But if you want to find out the intrinsic range, you could use the valuation snapshot. The valuation snapshot is available for every stock. Not every stock, for most of the stocks on the stock page. You'd get some idea, okay, here the value is expensive, here the value is fair.
The next question is from Mr. Nathmal. Please repeat how PEG is calculated.
Okay, I'll just repeat it. I'll go back to the slide over just a second. Okay, Okay, if you just share my screen, I'll just take it. Some of the investors must have understood it, some of you all must have not understood it. To keep it in very simple terms, we have PE ratio on the numerator and we have growth in earnings in the denominator. Okay, PE ratio is nothing but that multiple of the price. Okay, it's the market price of Godfrey. For example, if you look at the market price of Godfrey Phillips, let's look at it. It's 1855.50. I think I was close. I did 1845. Okay, but I took this at around 1 or 2 p.m. So it must have gone up. Market price divided by the earnings per share. Now, when I took the EPS, I went to financials, I went to quarterly results, and I looked at the last 12 months. Okay. So if you go to all data, you can get this data for a longer period. And where is the EPS? It's actually located down here below. Okay, EPS. So what I did is I added all the net profit, okay, for the last 4 quarters, which is 12 months. And then you have to actually divide it by the number of shares in the market. I mean, it'll get slightly confusing, but I went to company CV and I divided by the number of shares. So it has some 5.2 crore outstanding shares. And then I got the EPS. Now PE is very simple. We just do a division and we get 14.83. Growth in earnings was at around 50% trailing 12 months. You divide these two and you get the PEG ratio. In simple terms, if that growth in the earnings is higher than the PE ratio, it will always be below 1. Now, basic maths. Okay, if I do, let's say 1 divided by 1, I'll obviously get 1. Okay, as soon as my, let's say, growth slows down and I do a 1 divided by 0.5, I'll get a 2. Okay, or let's say I do a 2 divided by 1, I'll always get a 2. So as long as this division is less than 1, which is your PEG ratio, that's when Peter Lynch identified a GARP stock.
The next question is from Mr. Chaco. Dear Jason, if the earnings go down, then PE goes up. How does growth neutralize this?
If the earnings goes down, the PE goes up. How does growth neutralize? So you have to understand one thing about change in earnings. The reason I kept saying trailing 12 months is that because we are looking at a period. If once the earnings goes down, one particular quarter might not shift the entire growth rate. What I mean by this, let's say a company was, had 300 crores of earnings, 400, 500, and then let's say it came back to 450. Now, one particular drop won't make a major impact. But what you're saying over here, if the earnings goes down, okay, it will slowly impact the PEG and it will actually move closer towards 1 or cross 1 as well. But please understand, Mr. Chaco, one particular quarter shift won't make a major impact because we are looking at 4 different quarters or 12 different months previously. So it kind of smoothens it out.
The next question is from Mr. Dilip. How to find out growth rate? Any formula?
So when I looked at growth rate, how I found it out is I looked at the change in EPS. Okay. When I say growth rate, I'm talking about growth in earnings itself. Okay. I mean, there's no particular formula. You just divide the growth of this quarter by the previous quarter minus 1. But here, again, I've looked at 12 months growth in 12 months earnings. Okay. So I've divided last year's earnings, this year's earnings divided by the last year's earnings. And that's how I got the growth rate. Okay. I was worried of getting this, ratio into the webinar. I don't have an Excel handy right now. But if I had an Excel, I would actually quickly show you all how I calculated growth for this particular event.
The next question is from Mr. Amrinder. Thanks for these insightful strategy sessions. Please share your views on sharp fall in South India Bank.
I have not tracked South India Bank, but I'll just simply go and search on it. I have not actually tracked this particular stock. Okay, it's 13% down. There might be some, let's say, news or something. Let me just figure it out. Oh, here you get a clear one. So I went to news. South Indian Bank MD do not seek second term. Board begins hunt for a new head. When you begin hunting for a top management or a new head and you don't have clarity, it could be possible the stock actually cracked 13% because of this particular thing. On Markets Mojo, currently the score is at 62 at hold. Now you have to understand that one day movement should not decide your entire, stock picking approach. If the company still continuously fails to find a particular MD, then it would be a problem. But currently at minus 13%, it's a major sharp fall. Now this is sad because today's small cap has gone up, but this particular stock has gone down. It opened at a gap of 10.82. So this particular news was already read by the market. It could be this news, it could be other factors. I'm actually uninformed here, so I don't want to misguide you. Apart from that, the quality is currently average for that particular stock, I think. So it's slightly on the riskier side and it's a small cap stock.
The next question is from Mr. Prasad. Sir, Tech Mahindra has PEG 17.79 and is a Mojo stock. Whether this is a GARP stock?
So let's look at Tech Mahindra. There could be some reasons why it might not be a... So it's a buy rated stock. So I'll just share my screen. No. The PEG ratio is extremely high, sir. That's 17.79. My approach was picking on a PEG stock which is less than 1. So instead of, Tech Mahindra, HCL Tech has a PEG ratio of less than 1. Idea is to pick stocks with the PEG ratio is less than 1, not more than 1. In this ratio, we're not looking for a higher number, we're looking at a lower number. Not really sure why is it 70.7, but I have to do a calculation. But no, it's a clear cut no. This ratio has to be less than 1. So 0.179 was good, but 70.79, that means it's, not following under this model. But if you compare it with its peers, then it's an attractive stock. Okay, so just because, so don't look at one ratio of one company and compare it with anyone in the industry. Here you should look at the closest peers in the IT industry to get a better idea.
The next question is from Mr. Nandini Rodriguez. Hi Jason, please repeat how to compute PEG. I'm sorry I missed the explanation. Thanks.
Okay, sorry Nandini, I can't actually bore a lot of investors. I'll do a last attempt, but this webinar will be available, just after the event. So I'm sorry, but you could just scroll it backwards. I think there are many questions coming on how to compute PEG, or you can simply watch that out, and probably I'll also put a clipping on the page.
The next question is from Mr. Brar. Since Mojo recommendations take into account all possible negatives and positive 24/7 to derive a dynamic Mojo score, should we not go and buy Mojo stock at all time instead of trying to select stocks by ourselves?
Yeah, surely. So, buying Mojo stocks straightforward is not a bad approach. It's really good. The reason I'm doing this particular event is so that you're aware of what you're buying. No, I'm not saying that what the Mojo stocks are, you can simply go with them. But one thing I've noticed is that investors don't know actually how to invest in or pick stocks. What I mean by that, there are 40 or 30 to 40 different Mojo stocks. Within them, how should you design your portfolio? The reason I've spoken about the style matrix today and things like the portfolio approach, so on and so forth, so that you actually know how to make your portfolio from these Mojo stocks. So simply if I give you the top Mojo stocks and ask you to buy them, you'd be misguided. So the reason I'm doing these events is so that you're a bit more knowledgeable. Okay, I don't get afraid of investors who are a bit knowledgeable, ask difficult questions, because it's a learning experience. So if you're more knowledgeable, it also keeps us on track, and we are trying to give you better content. You can go straight and pick up these Mojo stocks. You don't have to do a lot of this homework into GARP model. But as long as you're aware of what you're investing in, I think you're a better informed investor, and you have a higher chances of being successful in your investment journey.
The next question is from Mr. Satyen. Is Fine Organic is a GARP stock? What is your view for Fine Organic?
Well, let me just have a look at Fine Organic. Okay, it's currently hold. So if you look at the Mojo score, it has a 42% fall from high as well. It's very close to sell, so it's actually taken a big fall. Now, if you look at the PEG ratio, it's at 0.09. Okay, so that's a good thing. And if you look at, let's say, the growth factors over here, sales growth is at 30%, profit growth. So yeah, it could qualify as a GARP stock. I cannot see the profit growth, but if I look at the sales growth and the PEG ratio, it could. It's currently down 42% from its high. So there might be a particular reason why it's actually dropped so much. I would not suggest you to go straight forward and buy this particular stock. Okay, it's very close to the border of hold and sell as well.
The next question is from Mr. Jacob. Do you have any method for identifying value trap?
Nice question. I don't have a straightforward method for identifying a value trap. But one thing I would like to tell you. When you pick a company, just because the price is low, I mean, that's not a go ahead. If the price is low, first thing, look at the earnings. Okay, what I mean by that is, if there's a particular company which has been battered down, fallen by some, let's say 50-60%, is at a very low end. But that growth potential of that company in the past looks good and also has growth potential in the future, then that's not a value trap. But if that company has been battered down for a reason and it does not have good growth potential, that's when it's a value trap. I'll try to give you an example over here if you share my screen. Okay, now look at SpiceJet's, let's say the price range, for example. Now in 3-year period, 106 was its high. Today it's at 30. Okay, so you can look at how cheap it has become from its past 106 high, it's come to 30. Now, if you just look at the price, you will say, you know what a value. What a value buy. Should I buy this company? Let's look at the financials. This is the financial trend. You can see it's a pure value trap. Now, investors often get misguided. Yaar, ye stock 106 ka tha, abhi 30 ka hai. I'll buy it and keep. God knows when it will become 106. No, it cannot become 106 because you can look at the financial trend. So this is a value trap, sir. It's not an attractive company. It's a, let's say a cheaper company. I'm using the word cheap. It's a bit harsh. But attractive is when the value is good and the fundamentals are also good. In this case, the value is good, but the fundamentals are not good. It's actually declaring negative trends back to back. This is the value trap. It's when you're stuck in a company saying, iska value kam hai, but it continuously falls low. It does not move from there because the fundamentals are not backing it.
The next question is from Mr. Amit. Most of the Nifty 50 stocks right now not coming under GARP. So what should be our strategy for these stocks? Is it worth to continue holding them, or we have to change in our strategy?
Let me just have a look. I'll just go to the particular screener section. If you just share my screen. So I'll select the pure GARP approach I made over here. Okay, I'll just remove this sales filter. Now you said Nifty 50, I'll go to index and I'll select Nifty 50. Two stocks. Two stocks in Nifty 50 follow this approach. Let's look at them. So we have Grasim, we have Bajaj. Okay, now both of them have a PEG ratio less than 1. Profit growth is excellent. Sales growth is also good. Okay, yeah, so there are two, so I don't think there are no stocks. So there are two stocks which kind of follow the GARP approach, where the PEG, now so you have to understand one thing, PEG ratio is less than 1, but Bajaj Finance is expensive on markets, Mojo. Now this might confuse you all. In one side I'm saying PEG less than 1 is attractive. Why is it showing very expensive for Bajaj Finance? Please understand, when we look at valuation, we don't stick to one particular ratio. Mr. Peter Lynch back then must have suggested this PEG ratio. We're looking at many other indicators. We're looking at PE, asset-based valuations. The previous webinar I explained this quite well. But just because the PEG is less than 1, we're calling it attractive, on markets more expensive. This can happen. Please understand, we look at many more factors when it comes to valuation, just not PEG. But if you simply apply the formulas, in that case, we have these two stocks which fall under the GARP strategy.
The next question is from Mr. Raj. Past performance is not an indicator of the future. Is an often repeated and standard disclaimer when it comes to investments. However, we assess a company based on its past more than on the future. Isn't this contradictory?
Yeah. So past performance is not an indicator, okay, but it's not a sure shot no that it won't follow. What we've seen over the past many years is that if companies perform consistently well over the past, they also show some trend in the future as well. The reason we don't look at future is because their bias comes in. I might think this stock will do well in the future. What are my credentials to actually boast about the stock? So we look at past performance, and I'm making this disclaimer very well. It's not an indicator. But what we've seen in our backtesting and what we've seen, as we analyze stocks, if consistency in the past is good, these companies do tend to perform well in the future as well because it's being consistent. We don't add a future projection. We don't add that because I personally feel that's a more dangerous side than simply looking at the past numbers and looking at consistency. I feel that this future looking is slightly very dangerous. When we were looking at the intrinsic value in the previous event as well, we were talking about the discounted cash flow approach. We discount the future cash flows. If I don't look at the past, okay, let me look at the future. Now, when we look at the future over there, please understand, there is very dynamic movements in the market. Today, one sector is good, today, another sector is great. I can't actually understand what would be the future cash flow or what would be the projection in the future. Okay, so that's why we don't look at the future. We look at the past and more of the present. We also look at today. And then we try to understand whether the company can do well in the future. So yeah, this disclaimer is there. We also follow this kind of approach. But I hope that's clarified.
The next question is from Mr. Neeraj. Good evening. Should the growth rate be calculated using financial year end growth of current year and previous year? In other words, can growth rate be calculated at any point of time in the year?
Not any point of time in the year. So for example, we don't get the earnings, every month. We get them quarterly. Okay, so that's why I've said trailing 12 months, which is nothing but the past 4 quarters. So when I calculated the growth rate for today, I looked at December quarter, September, June, and then we go back to March. Okay, so I'm looking at the most recent 12 months data which is available. Okay, don't look at financial year end growth because see, understand one thing. I don't look at last 12 months ago and go to previous financial year, right? I'm trying to look at the most recent data. And the idea of having the most recent data is because you're updated. If you start looking at the previous financial year or the previous half yearly trend, it does not make much sense. Simply go and check the last 4 quarters, which is nothing but the last 12 months trend.
The next question is from Mr. Mohammed. Hi sir, is Precall a GARP stock?
Okay, I'm just sharing the screen. It's a 70 buy rated small cap. Auto ancillary stock. Now it's changed from strong buy to buy. So it came down off the indicator. So that's something which is slightly negative. But yeah, let's see if it's a GARP stock. We look at valuation, PEG less than 1, yes. And when we look at growth, okay, sales growth is, I had used 15% and above, it's 13.5. But the operating profit growth is outstanding. I use 15. So under my strategy, it won't actually fall under GARP approach. It's not seeing a really great growth over here. So if you simply use my screeners, it won't fall under the GARP model.
The last question for today is from Mr. Shyam Sundar. Please explain your valuation model.
Okay, so the valuation model we use is that, so there are different approaches. We have the discounted cash flow approach when you look at valuation of a company. We have asset-based models. Okay, we also look at price multiples. Here at Markets Mojo, it's a non-linear dynamic model. Okay, what we do is, when we look at the valuation of one particular stock, we look at its valuation today, we look at its past multiples, and we also look at its multiples versus the closest peers in the industry. And based on all of that, we look at many different ratios over here. So if I just simply take you to the valuation card, you can see we look at PE, price to book, earnings value, PEG ratio, dividend yield, a lot of them. And not only for Precall Limited. We're looking at JT, KT, Shanti Gears, other auto ancillary stocks in the industry, and then we reach to an attractive range. We also print this graph for you over here. So that you know, okay, in this particular date, 155 to 337, so I have some margin over here. It remains in the attractive range. Then it enters fair, expensive, very expensive. Okay, so I'm not diving very deep into this. Most of the questions I've got today, this particular event over here, Unlock the Secrets to Undervalued Stocks, will actually explain to you all of it. I had also explained how the valuation model is actually calculated. So I would suggest you all to go to that particular video. This video will also be available on the webinar page. So I think, yeah, it's time's up. That's it with the Q&A session for today. And I'm really happy a lot of you all joined us today. And tomorrow on a special occasion, happy Ram Navami to all the investors present over here. It's a market holiday. Take a break, sit back, enjoy your time. I know it's been a very volatile phase over the last 1 week. But day after we are again back, we have the equity outlook for the month of April, hosted by our Chief Investment Officer, Mr. Sunil Damania. We'll be shortly sending all invites for the same. Don't miss that particular event. Looking forward to seeing you all come for the events in the future. Goodbye and have a great holiday. Thank you.